You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Thursday. The market is going up and going down these days. It's kind of crazy, right? But one thing is for sure is while we have those small glimpse of hope where we have some good days, the fear of having a recession is still real. And when the tides goes out, as Buffett like to say, we're going to find out who's swimming naked, right? And you don't want to get caught by this. If the past few months have scared you a little bit with the volatility and everything, there is one thing you should be doing right now is to review every single of your holdings and review them to make sure you do not have potential dividend cutters. Why? Because when we have a bad market, it's usually because we have a bad economy. And when we have a bad economy, companies are struggling. And when companies are struggling, well, you guess what? They cut their dividend. You know, I started my career in the financial industry building credit cases for investment loans and mortgages. So my goal was to assist clients to build their file and then to send them to the credit. It taught me a lot because we were directly in discussion with the credit department. We were doing major loans. I'm talking about like more than $100,000 investment loans. And at the end, when I was at the end of that first portion in my career, I was managing what we call the big loans, so over $1 million investment loan and plus. So when you build those cases, it's like real money. The risk is great because from the banking's perspective, it's a lot riskier to lend $2 million to one individual instead of lending 20 $100,000 investment loans, right? Because of course now you have one single person, so you have a concentrated risk, and I want to use this risk perspective and credit perspective to look at how companies should what's the likelihood of a company to cut their dividend or not, because it's really, when you think about that, is you kind of are the lender in this case. You're kind of like the bank, because you wonder if the business that you hold in your portfolio will manage to pay their dues, to pay their dividend. And even worse than that, than a bank, you have absolutely no guarantee. So if the company cuts their dividend, it will have no impact for them. The stock price is going to drop, but surely the stock has been affected already. So there are three key points I want to give you as factors to look out when you analyze a company to say if the business is going to cut their dividend or not. So the first one is the history. So when you run a credit check, you want to look at the credit history of the company, of the person that asked for a loan. Well, then when you look at a business, you can look at its dividend history. So for how long the company has been paying a dividend, for how long has been able to increase it, which is even better. So that's a lot of bonus point in my mind, especially right now, because since the financial crisis of 2008, we didn't had a big recession or anything. We had yes, speed bumps and stuff, but it wasn't that bad. So if a company has not been able to increase its dividend over the past 10 years, there's probably a problem here. You can also look at the dividend history during recession. So how the business was able to navigate through past crisis to past recession, because the pattern will likely repeat. Similar to someone who always end up being late on their payments, on their car payments, or on their credit card payments. Well, you're going to see the same thing for a company. If the business is super cyclical, well, you're going to see that the dividend will stop increasing or will be cut whenever there's a recession or the numbers are a little bit slower than usual. So that's the first one, looking at the history overall. The second thing is to look at the trend. If you look at an individual and then you see that the credit card balance is growing from one month to another, and it's been a few months, and now we have one payment that is late like 30 days, well, you see that the trend is not looking good, right? It's like keeps on increasing. You have like a slowdown in the payment. So that is a sign that things are not going to go well for that individual and likely going to default on their loans and fall into the provision for credit losses, right? You don't want to put a lot of your companies in your portfolio into that category of like provision for credit losses. So when you look at the debt trend, the revenue trend, the earnings per share trends, and of course the dividend trend, when you look at those trends, you can look at like cash flow as well. At Dividend Stocks Rocks, we have like graphs showing you the past 10 years. So it's really easy to determine if the company keeps on racking up more and more debt every year, but the revenue is not increasing too much and the earnings are slowing down or actually decreasing. Same with cash flow. Well, your dividend is at risk. That is just pure math. It's it's obvious, but it also enables you to get out of the fairy tale that you're telling yourself that everything's going to be okay, that this company has been around for so long. When you look at the trends of each of those numbers, the debt, the cash flow, the revenue, the earnings per share, the dividend, those are like 5 key metrics that if over the past 5 and 10 years are not going towards the right direction, you may end up having a potential dividend cutter in your portfolio. If you want to avoid to have those, I suggest that you focus on companies with thriving metrics, especially based on the 3 pillars of the dividend triangle. So revenue, earnings per share, and dividend. And if you're looking for a place to start your research, I created that list for you called the Rockstar List. You can download it at moosemarkets.com/rockstars. And in this list, every single month, I'm going to send you a new one. It's only companies showing positive numbers for revenue, earnings per share, and dividend growth over the past 5 years. The list is updated monthly. You just have to subscribe to the newsletter. So moosemarkets.com/rockstars. So, all right, you look at the history, you look at the trend, and then there is one last thing super important. And in credit, it's like the key thing is the ability to pay, right? It's super simple, but this is how you can narrow down your analysis. Within a few minutes, you'll know if you have a potential dividend cutter or not in your portfolio. Debt ratio, liquidity. If you have like the best guy on earth, the guy is just like super sweet with everyone, but he earns $1,000 per week and he already has $900 per week of payments. Are you going to give him a car loan of like $200 a week? That's not going to work out, right? Something is going to fail. Just because that person, even if it's the sweetest guy that you know him for a while, that he's always been reliable and paying on his debt, now is taking on too much and the debt ratio is way too high. So if you want to translate that for a business, super simple. Once again, you look at the payout ratio. If the company is paying more in dividend than it is its earnings, well, the payout ratio will be above 100%, and that is not good. Just one thing here, it's important to put the payout ratio in the right context and to analyze the right payout ratio for the right type of company. I recently explained that at Dividend Stocks Rock during a webinar. We do have actually a full DSR fundamental newsletters explaining the different types of payout ratios. So you have the classic one based on earnings, but earnings will include non-cash element, right? So like amortization, for example, it's going to reduce earnings, but it doesn't affect the company's ability to pay its dividends. So maybe you will find a company with a high payout ratio. That's a red flag, but then you investigate and you find out, oh, the company has a high payout ratio simply because it has a lot of amortization or impairment charges that are not on non-cash events. And the cash flow payout ratio is actually well in order. So the cash flow payout ratio will focus on free cash flow. It has its pros and cons as well. You have also the funds from operation payout ratio, so the FFO payout ratio. You can calculate the payout ratio based on distributable cash flow or distributable earnings. So again, it's really important to identify the right payout ratio, but the ability to pay will be determined by this ratio, and it's going to tell you a lot. So by combining the 3 factors I told you today, the history, how the dividend has evolved throughout market crisis, throughout financial recessions, the trend of key metrics such as long-term debt, cash flow from operation, revenue, earnings, dividend, and finally, the ability to pay the payout ratio. So if you combine the three of those factors, likely you're going to identify the potential dividend cutters in your portfolio and the one that you can sleep well at night, no matter what happens with the commercial war and everything that is going on right now in this world, you can sleep well. So right, Moose, that's enough for today. 10 minutes sharp. Super happy about this one, actually. Don't forget to give me this 5 seconds to go on Spotify or an Apple Podcast. Give me a 5-star rating. Put some comments there. It helps me to grow the podcast and to share the love across all Canadians and all Moose. All right, so we're going to talk again tomorrow. Tomorrow, we're going to talk about how to use ChatGPT to enhance your retirement. That's going to be cool, right? All right, so stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.